Good morning and welcome to our live RavenPack webinar in conjunction with WBS training on 5 ways to maximize alpha by leveraging NLP earnings intelligence. In today's webinar, we will be covering 5 of our latest research papers on earnings intelligence, as well as introducing a novel macro strategy approach based on earnings call transcripts. I'll be introducing the concept of earnings intelligence that combines sentiment from across earnings call transcripts, news, and global insider transactions. Anmar will then present on how earnings intelligence can be used to enhance factor investing and credit strategies. And finally, Paolo will show how a US economic activity sentiment indicator can be created from our transcripts data and be applied to an asset class rotation strategy. Should you have any questions throughout the presentations, please do post them in the chat window. We'll be opening up a live Q&A session towards the end of the webinar, where we will try to address as many of your questions as possible. Now, allow me to introduce myself. My name is Peter Hafez, and I am the Chief Data Scientist here at RavenPack. With over 20 years of experience in quantitative research, data science strategy, and product development from fintech startups to global banking, I lead distributed, mission-driven data science teams that create actionable insights from unstructured data using NLP-driven analytics. Our mission here at RavenPack is to innovate, to create, and to communicate value-adding insights to our clients across fundamental and quantitative mandates, across multiple asset classes and investment horizons, and across various industries and geographies. Now, let me tell you a bit about RavenPack. We are a financial technology company with expertise in natural language processing, analyzing hundreds of thousands of articles on a daily basis. Our clients span a large range of use cases, including quantitative investing, risk and compliance, algorithmic trading, ESG, business intelligence, and research. Today, RavenPack employs more than 200 people globally, representing more than 30 nationalities, speaking 24 different languages. With the recent launch of our latest NLP technology platform, RavenPack Edge, we now cover more than 40,000 sources of content, spanning not only news, press releases, and blogs, but also conference call transcripts and SEC filings data. We produce more than 80 analytics, including 20+ targeted sentiment scores across 13 different languages. Our analytics are produced across more than 12 million entities, capturing not only public and private companies, but also people, products, places, organizations, currencies, commodities, and themes. Core to our NLP technology is our event detection capabilities. Today, we cover 7,000+ events, neatly organized into a multi-layer taxonomy, covering business, economic, political, societal, and environmental events. This produces a large set of data building blocks, which can be utilized to create indicators that target a wide range of insights and use cases, all of which can be addressed with more than 20 years of historical archives. Today, I'm going to be speaking about everything from earnings call transcripts to earnings news and insider transactions, and how you can generate what we refer to as earnings intelligence. Every quarter, earnings calls provide investors with an opportunity to gain additional insights into company performance, insights that often go beyond the corporate press release or the filing. In particular, we are able to extract sentiment from earnings call transcripts using RavenPack's Edge data, which have been found to be correlated to subsequent market reactions. Immediately after an earnings call transcript becomes available, RavenPack generates a rich set of scores, tags, and other structured information in real time. A transcript is typically delivered with a delay of less than a day after the actual call takes place. Considering the coverage, we find that 90% of US mid and large cap companies are covered by the database, while US small caps see about 75% coverage. In Europe, mid and large caps have about 80% coverage and small caps about 50%, where Asia markets are somewhat thinner, but something we're working on to expand from a coverage perspective. When it comes to event coverage, looking at transcripts, not surprisingly, we see a strong tilt towards earnings and revenue related events. But we also see a fair amount of equity actions, products and services, and investor relations information that all contribute towards a more complete picture of company performance. From this information, we create 3 different trading signals. We create an event sentiment signal that considers key events and their sentiment scores identified throughout the earnings call. We create a document sentiment signal, which utilizes machine learning to measure the sentiment of every sentence transcribed from the earnings call. And finally, we also produce a transparency score that looks at the number of market moving events disclosed by the management team. In constructing our signals, we not only consider the sentiment of the individual transcripts, but rather the change in transcript sentiment between 2 consecutive earnings cycles. We do this because we found it impossible to find an overall negative transcript. It's the sentiment of the it's not the sentiment of the transcript itself that drives future returns, but rather the change in sentiment. And to slow down our signal, we apply exponential smoothing to achieve our desired effective holding periods. So if we look across our 3 signals, we found that they were more or less orthogonal, and that overall and they delivered overall positive performance. While we saw that document sentiment was the strongest standalone signal of the 3, we did find that the transparency signal exhibited meaningfully different behavior with slower decay, especially over longer holding periods. And given this orthogonality, we were able to combine the 3 signals to find even more robust performance across different universes and across different holding periods. In particular, we were able to achieve information ratios of around 1, about a month out, in US mid and large cap universe, and an information ratio of about 2 for our small cap US universe. But one of the things that we started thinking about, or that we were curious about testing, was, hey, what does transcript sentiment actually look like when you compare that to what information you might get about earnings from news? We already cover news, or have been doing so for many years, news and press releases and so on. And they also cover earnings information, as I mentioned. So we wanted to take a look at the value add on top. We created a similar type of sentiment signal from news. So we would take the average earnings sentiment on a given day, and to sort of translate the transcripts-based signal construction and do a news equivalent version of it, we took the daily sentiment score across earnings sentiment, and then subtracted a 4-month rolling average, and then applied a similar decay function. And what we found was quite interesting. First of all, we found that the 2 signals actually complemented each other quite well. But if you look at the short term, news was clearly the stronger signal. But we also found that transcripts-based signals outperform over the longer horizons. Still, with this sort of value coming from both, and the somewhat complementary information, we were able to improve the signal by combining the 2 together, especially over the first 1 month. So we also wanted to check if we could add additional value by looking into what the executives were actually doing. So not just what they're saying, but also what they're doing. So we wanted to look at whether companies that had particularly strong earnings transcript sentiment would outperform more if there had been net buying leading up to the conference call. likewise, we wanted to look at companies that had particularly poor earnings transcript sentiment, and whether they would underperform more if there had been net selling amongst the executive team leading up to the conference call as well. And what we found was that you quite consistently were able to improve performance across different universes and across different market caps. In particular, we were able to boost information ratio across nearly all investment horizons by up to 20%. If we look at it from a cumulative return perspective, we could also see quite robust performance over time. And in particular, it's interesting to see how performance in the last couple of years have been particularly strong for slower moving signals. So as I described previously, when you combine transcripts with earnings news and with insider transactions, you get to the concept that we'd like to refer to as earnings intelligence. It gives you a more complete picture of what's really going on with a particular company. And we find that this earnings intelligence signal is able to generate excess returns that are unexplained by traditional factors. Here I show you in particular the US results across mid and large caps and small caps. However, as we expanded into European markets, we saw very similar performance. Or in fact, we saw slightly better performance, since European markets tends to be a little less efficient, and therefore our signals are even slower moving there. However, we found that we were not only robust across market capitalization and in factor control, but also very much so across regions. What's obviously also interesting is to start to look at whether you can utilize these earnings intelligence signals and ingesting those into other types of applications. And with that said, I'd like to introduce you to my colleague, Anmar Al Wakil, who will share with you how he was using earnings intelligence to enhance factor investing and credit strategies as part of his most recent research. Over to you, Anmar.
Thank you, Peter. So as I am speaking now, US equities and bonds are both down by 12% this year. So we live in times where the traditional 60-40 bond equity portfolio no longer works, and the trend of the last decade is over. We expect more headwinds to come, rate hikes and balance sheet reduction from central banks, inflationary pressures, and weaker economic prospects. So in this context, this is easy to understand why security selection has never been so instrumental for equities and bonds. In my presentation, I will show you how earnings intelligence can help you to timely pick the stocks and the bonds with more resilient corporate earnings. In this application, we enhance equity factor investing. As you know, passive investing is mainstream among institutional investors, but at the expense of active managers with stronger stock selection skills. At the intersection, we find traditional factor investing, and traditional factor investing is crowded while the performance is disappointing. In this context, we believe systematic beta investing can take advantage of earnings intelligence. Because on conference calls, executives, investors, and analysts discuss hard information about forward-looking profitability, earnings quality, and future prospects. But earnings intelligence also captures hidden source information from NLP analysis. Sentiment and linguistic tone, they can reflect operational efficiency, management quality, and capital structures. So this is why earnings intelligence can help you to enhance factor investing. First of all, let's consider the traditional factors. Traditional factors are long-short strategies and dollar-neutral strategies. So each month, we rebalance the benchmark weights in blue. Then we calculate the sentiment scores 30 minutes before the market close. And we assume that individual stocks with more positive sentiment will outperform. And finally, we overweight these stocks, giving the tilted factor weights in purple. We found that first, tilting factors with news enhances considerably the performance, and second, we found that the outperformance was mostly on the short term. As you can see, the yellow line is the performance of the benchmark for value, growth, low size, quality, momentum, and low volatility. So the more you tilt toward news, the higher performance you get. But if you aggregate the sentiment score over 1 month in red, or 6 months in green, or 3 months in blue, the short-term alpha decays rapidly. So in other words, trading the news is profitable, but mostly for a short-term trading. This is why using transcripts is so instrumental to complement the news. As we highlighted before, transcripts contain information that is more difficult to interpret and to consume. And this is particularly true across the large cap companies, where the news tends to be less informative, I would say. So as you see, tilting toward transcripts in blue outperforms across the mid and large caps. But across small caps, news in red is better in mitigating the asymmetry of information. As a result, earnings news and transcripts convey orthogonal information about a firm. And when you combine them, you can take advantage of the multidimensional representation of the firm. We will illustrate this particular point with the value and the growth factors tilted with news at the top and transcripts at the bottom, and depending on different signal aggregation from 1 month in red to 6 months in green. As you can see, earnings intelligence at the right outperforms the individual signals at the left, because earnings intelligence combines the stronger short-term alpha from news to the stronger longer-term alpha from transcripts. We will now understand why the signals can enhance the stock selection skills. Here we measure the performance per unit of active bets for 3 different factors: for profitability, investment, and yield. So in theory, the best stock picker should be located at the top left of the factor. We found that the more you tilt, the more you concentrate the portfolio on fewer bets, and the more you outperform the benchmark in yellow. When we test the significance of outperformance at the right, this result is still robust. So we simulate at the right the probability distribution of information ratios in green from random portfolios. And what we found is that tilting towards new sentiment in red always performs better than chance. Finally, we combine the enhanced factors. We rebalance the multi-factor strategy on a monthly basis, and we allocate the factors using a very classical optimizer, the risk parity optimization. We tilt towards news in yellow, transcripts in red, and earnings intelligence in green. As you can see, the backtested performance of the benchmark is disappointing. While earnings intelligence in green reaches an information ratio of 0.51 on top of the benchmark. So this was the first application about equities, and in the second one about credit, I will show how earnings intelligence can enhance your bond selection skills. We tilt here a long-only credit benchmark for bonds that are investment grade, senior, and secured and liquid, and for bonds that are denominated in US dollars. We calculate the benchmark weights on the previous day. Then we calculate the sentiment scores 30 minutes before the market closed on the current day. And finally, we overweight the bonds with more positive sentiment. At the left, we evaluate the risk-adjusted performance depending on the effective holding period. So each point corresponds to a tilting magnitude. First of all, we observe that the more you tilt, the higher the information ratio you get, but also the higher portfolio turnover is. At the right, we calculate the returns in excess of the benchmark, and the result is even more interesting. If you want to harvest short-term alpha, you should trade the news in red, but you should trade them quickly. And if you target a longer horizon, you should trade the transcripts in green. And the combination of the two signals in green outperforms the individual signals while decaying faster than transcripts. So then we dug a little deeper to understand why. We found that earnings intelligence complements the bond selection skills. First, we evaluated the outperformance per unit of active bets, as you can see at the left, and we adjusted the returns in excess of the benchmark at the right. As you can see at the right, news in red has an inverse behavior with transcripts in green. And we found that news picks the right bonds to generate short-term alpha, while the transcripts picks the bets that outperform over the long term. And finally, earnings intelligence in blue outperforms the two signals, but with the same number of active bets. In the following slide, I will show you how we control for the backtesting bias. We tested the statistical significance of the outperformance, and we evaluated whether the signals significantly outperform zero skills. In blue, we simulated the probability distribution of information ratios by generating random portfolios, and what we found is that tilting towards sentiment always performs better than chance. This result is particularly true for earnings intelligence in green. I could speak a lot more about the results, but I need now to leave the floor to Paolo and Andreini. So to conclude very briefly my talk, I demonstrated that earnings announcements provide orthogonal sources of information. And by combining them, this information statistically complements the security selection skills. Thank you.
Hello, everybody. Good morning, good afternoon. And I will now introduce how we leverage transcript in order to track economic activity. We basically we gather the data from Fact Transcript, and we have more or less 500,000 transcripts call spread out across 15,000 companies. The time horizon goes from January 2003 up to December. Using the NLP from Ravenpack, we are able to analyze the document and detect macroeconomic events. So not just purely business and financial events, but also all the comments and all the narratives from managers around macroeconomic condition and situation. And as you can notice here from the pie chart, they are mostly related to economic activity, economic growth, unemployment, and retail sales. So we focused mostly on the real macroeconomic activity. What we built here, we start from a macroeconomic view of the world, because what we do, we use disaggregated news at a company level, basically, that do a comment about US GDP, US unemployment, or other macroeconomic variables. So what we do, we basically move from a macroeconomic view to a macroeconomic view. So we aggregate those daily news, those multiple daily news into a daily indicator, and we then is aggregated over time. And over time, it gives you the opportunity to smooth a little bit the noise proper from the news. And what is the end product of this is our transcript economic sentiment indicator called TSI. It is basically a bottom-up indicator which aggregates the firm's micro-level view about the US economy into a macroeconomic signal, so at aggregate level. This is an example of what the news that we gather, and also how our NLP infrastructure is able to go from unstructured data to structured data that are going to help our analysis, and also how we have improved our product using Edge by introducing new event categories in order to differentiate when the word within some sentences are different. Once we gathered all the data, we built this transcript economic sentiment indicator called TSI that is plotted here as the yellow line, and we use that to time the macroeconomic activity. What you see in this chart is the transcript economic sentiment indicator versus the GDP preliminary release at the release date, and the shaded areas defines the business cycle phases identified by the TSI, so by our transcript indicator. And how to identify the business cycle phases, we define 4 different business cycle phases. We look at the change of the TSI with respect to the year-on-year change and the level of the TSI. And we define expansion, slowdown, recovery, and contraction, depending on where we are, what our indicator is suggesting. As you can see here from a first view, you can notice that our indicator is able, now I'm going to zoom in some specific periods, the so-called Great Recession and the COVID recession, in order to show you the capability of our TSI indicator to do a proper timing of the business cycle. You can already see here that it does a quite good performance during 2007-8 and the recovery of the Great Recession. And also in 2016, it can detect the slowdown of the US economy and the increase in the interest rate that the Fed has done after the financial crisis. And then it can also detect quite rapidly, include quite rapidly the COVID crisis. Let's zoom in on the Great Recession to see when our indicator based on transcripts was able to detect the start of the recession. So as you can see here, since the beginning of January 2006, the TSI starts to worsen its condition. So it goes from a positive territory into a negative territory, identifying a contraction phase in October 2007. The definition of this contraction phase basically is the red part. It starts way before the official start of the Great Recession in December 2007, which was announced by the NBR only in November 2008. So you can see that managers were already talking about a slowdown of the US economy in their earning calls. So they were concerned about the ongoing situation in the US economy. And after after January 2009 and the beginning of February 2009, the TSI identifies the recovery phase. And also in this case, you can see that it anticipates the actual GDP release and also the NBR released phase that it happened only in September 2008. Zooming in during the COVID recession, instead, the situation is a little bit more complicated because, as all of us are aware, that was the shortest recession in history because basically it was even shorter than a quarter because the NBR has defined that the crisis, the COVID crisis, was from February 2020 to the end of April 2020. So it was basically 3 months. And what you can notice here is that the TSI starts falling at the beginning of March. That was a good signal, but it defined a contraction phase only the 27th of March. So basically, when already all the like pandemic effects about closing economic activities and slowdown from the production side and also the consumption because people were locked in their houses was already started. So in this case, the TSI is limited by the capabilities of the earning calls transcript, but it is able to introduce this news quite rapidly because, as you can see, there's deterioration of the signal already in March. While if we would have waited the release of the GDP, we would have needed to wait until the end of April 2020 in order to identify the first negative quarter related to the COVID recession. Here is positive that the TSI starts the recovery during the summer, and as you can see, it goes into like a recovery phase already during the summer, and then it piles up to a positive territory throughout all the 2021 as it was then backed up by the economic situation. In order to enlarge our experiment, we didn't focus ourselves only on identifying the business cycle phases and see how they can be detected. But we try to extend this exercise by also doing a timing strategies between stock and bond. So we wanted to see the capability of these signals in order to create profitable investment strategies. What we did, we basically implemented 3 very simple long-only strategy, systematic, based on stock and bonds. As a stock, we use the S&P 500, and as a bond, we use the 10-year Treasury bill as indexes. And we basically implemented those 3 strategies. We call them full rotation, gradual rotation, and extreme rotation. The differences between those 3 strategies depends on how we decide to allocate between stock and bonds when the TSI identifies a specific phase. So for example, in full rotation, if we identify one of the green phases called recovery or expansion, we decide to invest 100% in stocks, while instead, if we identify one of the red phases, so a slowdown or a contraction, we decide to invest 100% in bonds. Gradual rotation instead, depending on the phase, we allocate our portfolio in a different way, and we allocate the 100% of our portfolio in stocks only when we identify a recovery phase, and 100% in bonds only when we identify a contraction phase. We analyze those 3 strategies at 2 rebalancing frequencies, daily. So we rotate as soon as a new phase is identified, and monthly. So we rotate at the end of the month based on the phase that the TSI is identifying on that day. Of course, as also like we shown in the paper, we do a robustness check when we identify a new phase. So when a new phase is identified, we do not switch the portfolio on that day, but we need that signal to be somehow stronger across a couple of days in order to decide, okay, we are shifting phase, we are shifting regime, so then we have also to change our investment. Here in this chart, I'm showing the performance at a daily rebalancing, and we compare those three portfolios versus a 60-40 portfolio and a 50-50 portfolio between stock and bonds. At a daily rebalancing, what you can notice here is that in terms both of Sharpe ratio and cumulative returns, strategy based, especially the gradual rotation and the extreme rotation that are based on the TSI signal, are able to overperform in both in Sharpe and in cumulative returns, the two more plain vanilla strategy between stock and bonds. What you can notice here is that we are able, from the previous chart of the TSI, when the TSI is used to identify the business cycle phases, we are really good in overperforming during the financial crisis in 2008, basically. But then we take a huge loss during the COVID recession because of the identification of the TSI realizes we are in a recession phase basically with a couple of days of delay, especially also because we are able, yes, to introduce news in a timely matter, in a timely way, but in macroeconomy, when we try to smooth the signal in order to aggregate over time, the aggregation over time, it penalizes us a little bit. So what we decided to do, we decided to try the same strategies at a monthly rebalancing frequencies. And also in this case, the strategy based on the transcript signal overperform in terms of Sharpe and cumulative return, the naive strategies between 60-40 and a 50-50 portfolio. And also in this case, there's a clear separation during the financial recession, because as we've seen, the transcript was able to include those news in a timely way. And we notice, especially in the cumulative returns chart, that there's a clear separation between the TSI based strategies and the long-only portfolio strategies based just on investing in the two assets. But also in this case, we noticed that a lot of our performances is ruined by the COVID period. So what we noticed, we decided to take like to analyze another monthly variable, the US ISM PMI manufacturing, that has like a monthly frequency as well, and it gives a signal about how good the it's still a manager survey, so it can be somehow comparable with the transcripts, because transcripts comes from managers and the PMI surveys are questions that are asked to managers. So basically they are somehow comparable, and so we decided to overlay those two signals, the TSI and the ISM PMI manufacturing. And by overlaying, we decided to use a very simple formula, a very simple combination by using a weighting scheme. The weighting scheme uses a 12 months rolling hit ratio between the two signals. So basically, the return of the strategy is simply a weighted average between the strategy from the return from the TSI strategy and the ISM strategy, where the weight is given by how many times the TSI has overperformed the ISM or the other way around. So basically, we have a dynamic weight that gives more weight to the signal that has performed better in the last 12 months. By doing so, those are the results. I'm showing here only the full rotation effect, the effect of this overlaying only on the full rotation strategy. And what you can see here is that the full rotation strategy based on solely the ISM PMI manufacturing signal is able to reach a Sharpe ratio of 0.91. If we solely based on the TSI, we are able to reach a Sharpe ratio of 1.01, so slightly better. But if we overlay, we are able to reach a Sharpe ratio of 1.21. Why? Because basically, by overlaying the two strategies, we are able to get the positive effect from the 2008-2009 financial crisis. And then we are not killing our performances during COVID. Why? Because the ISM PMI manufacturing was signaling already a slowdown in the economy at the end of 2019 with respect to the end of 2018 already in the data. So managers were saying that the confidence that they had about the US economy was already slowing down at the end of 2019, beginning of 2020, with respect to the previous year. So that gave this additional strength to the signal, and the combination of the two is able to capture what's good from the TSI and also what's good from the ISM, and combining them together in order to achieve quite good performances over this sample of time. Of course, during the paper, we did also like additional checks using different rolling scheme windows, and the performances are pretty robust, depending which weighting scheme and which size of the rolling window you would like to decide. So this is how we leverage the transcript inside the macroeconomic space. I hope you liked it, and I will give back the word to Peter for the final key takeaways.
Thank you, Paolo. Before I kick off the Q&A session, I'd like to highlight the key takeaways from today's presentations. We have first of all shown how earnings intelligence provides an unexplored source of alpha, combining news, transcripts, and insider transactions. We also showed how it was possible to enhance equity factor investing and credit benchmarks using this earnings intelligence signal. And finally, we showed how earnings call transcripts convey information about the economic business cycle, which can drive asset class rotation. So now, at this stage, I'd like to open up for questions, and I can see that there's a few questions that have come in directly as well. Feel free to still post questions in the general chat. But I have a question here for Anmar, talking about or asking about the more recent performance, or sort of bringing more recent performance now that we have seen a market, both a credit market or bond market and an equities market that have been quite challenged. So Anmar, how does performance compare between news and transcripts over the last quarter?
Yeah, this is a very good question. I think that this quarter, fixed income markets have never been so challenging. For example, we now see that interest payments are now offsetting the principal loss due to the rate hikes, for example. And we also see that credit markets are anticipating many additional headwinds. But as we usually observe during crisis, news tend to outperform transcripts during crisis, because transcripts tend to be slower than news to capture the regime shifts. During market downturns, for example, we usually observe that news is faster because market participants are usually overreact to the news. So in this particular quarter, we found that tilting toward news brought strong resilience in the portfolios in the short term, while on the other side, we also found that the complementarity between news and transcripts is getting stronger, because transcripts help denoising the news in the longer term.
Thanks, Anmar. There's also a question here about the various sentiment scores that have been used across the various strategies, whether it's daily or they are less frequent. I will take that one. So in principle, RavenPack is producing providing a low latency feed of analytics that feeds in a real-time way. So you could, in theory, update your scores on a continuous basis, at least for news components. However, we are calculating scores as part of the various studies on a daily basis. There were some strategies that were looking at monthly rebalancing, and in those cases, it would be a monthly calculated indicator. But it is basically built from the building blocks, if you may say, that are made available in a higher frequency setting. So there's also a question here for Paolo about the performance of the TESI year to date. Given that we have seen a rising inflation and both stocks and bonds have been hit, did you try to include more asset classes in your studies? And one thing could perhaps be something more like sector rotation, or of course also more broadly in the commodity space.
Absolutely, that's a good point. So basically, the TSI has been updated until the end of December, and when we produce those results, we haven't updated it yet. We are planning to do so because another thing that I just mentioned at the beginning, but I haven't developed on that, is that I focused only on news related to the real macroeconomic activity. So basically, I've excluded most of the news related to inflation, prices, and so on. I think that we are currently, that we want to include is the inclusion of those news in order to see what is the effect on the TSI, especially in the latest period, because those were the main concern, and also those could have been the main concern related to the economic activity, because if we just focused on news related to GDP, especially at the beginning of Q1, before the start of the war, probably people were still a little bit confident to have like this larger growth rate in the economy for the US, but they would have been concerned about the rising in inflation as well, and the rising in energy prices that could have damaged the economy and the purchasing power of the consumers, basically. So that's what I would like to extend, and yes, it's in terms of like the TSI, and then yes, we would like also to do like a proper asset allocation, including different asset classes, and maybe also something related to inflation linked, to see if we could improve in terms of performances, so not just limiting ourselves on two asset classes, but try to define cyclical and defensive asset classes in order to diversify better our strategy. But it's something that we are working on it, and that we are gonna analyze better the data that we have available.
Thank you, Paolo. There's another question here, which is also a more general question. Do you, and I can probably cover that one. Do you utilize sentiment scores from all available events, taxonomies for prediction? There's sort of multiple questions embedded, but I'll sort of answer this one at first. Yeah, I mean, in this particular study, we have focused a little bit more on events that are related to earnings. So when you look at news, we basically carve out any earnings related events from our taxonomy, but in principle, our event detection capabilities also go beyond earnings. So we do products and services, M&A activity, various corporate actions as well, buybacks or whatever it might be here. There's also more ESG related events. But for these particular studies, we have focused on earnings because it was sort of a complementary analysis to the earnings call transcripts. However, when we do look at earnings call transcripts, we actually go broader in the taxonomy, that we also look at whatever discussion there might have been around products and services and so on. So we do consume all of the events throughout the call when we create the event-driven signals. The document sentiment score is a pure sentiment driven analytic, but the event sentiment score very much utilizes the various events that we are able to detect. There are also a question here around leading and lagging events and how we sort of deal with that. I mean, within the taxonomy, you can filter. I mean, we do also detect stock price events, which tends to be a little more lagging than leading. So you can clearly filter this out. In the ways that we have created the signal for this presentation today, that wasn't necessary. because they were more earnings related and hence had more direct predictive power. But you can work with the data and filter the data as you see fit, and pick the exact building blocks you want. Look at marginal contribution by dropping certain events. You can do event studies, of course, to get a deeper understanding of these sort of things. And in terms of, there's another question here around missing values, for instance, over weekends for price data. Well, you just, I mean, news is 24/7. Transcript a little less so. You don't see many transcripts over the weekend, but news is definitely a real-time aspect. You do see less news during weekend, but they definitely do appear. And the way to sort of deal with that, depending on asset class as well, but the way to deal with that is to sort of carry over the news over the weekend into your Monday bucket. In terms of other questions, there is a question related to the decay factor that is applied to all of the variables in the strategies presented. If the decay factor have some effect, basically is the question. I think for some of the strategies, there's no decay. Paolo can probably speak to that in terms of the macro study, but in terms of the earnings intelligence signal, we basically apply different decays, and that's the way that you get to your effective holding periods. So in those graphs where you saw the sort of the signal decay across time, it's really the performance that you would get from applying different decay functions such that you created faster and slower moving signals. But of course, the further back you go and slow down your decay, you trade on older information, and that does influence performance. Paolo, I don't know.
To add on, yes, to add on that, for what I've done, basically, I've used only what I've used to be honest, decay factors, because on a daily level, the news are like the transcripts they're less noisy than news, as Anmar pointed out, and but still I prefer to aggregate them over time, also because I'm playing in the macro field. So unfortunately, with respect to my equity and finance colleagues, I have less data points, so I need to play with what I have I have left after the filtering. But I use a 30 days decay factor because I would like to build something that is on it has like a monthly shape in order to also be comparable with the ISM in my manufacturer, and not compare something that is completely different built in a completely different way. I've tried also to do like a decay factor quarterly, but is of course is much more slower. And the crisis of 2008 and 10 is still quite able to detect it in a good way, but it's very lagged. It's very delayed during COVID. So it's basically a trade-off. But usually macros in other studies that I've done with Ravenpack data since I've joined the company, in terms of like now casting economic activities or other macroeconomic variables. Aggregating monthly, it is or over a month horizon with a decay factor of 30 days. It's the best recipe, because more or less all the narratives around macroeconomic variables happens on a monthly level. So that's what I found the most value in.
Thanks. There's another question here related to the insider transactions information and whether that's included in the Ravenpack products. And also, how is that quantified? Well, there's actually two different ways of looking at insider transactions from Ravenpack. One is looking at our news packages. Whenever insider transactions data is covered in the news, it will be extracted from the news and quantified with sentiment scores and so on. There's also a different product where the insider transactions data is extracted from filings, global filings. So it's a global data set. and it has much more elaborate information available around whether it's what type of insider transaction it is, whether it is an outright purchase, for instance, of stock, or whether it is an option program or something that is running out, or a more tax-based transaction. If who's doing it, is it what level of is it the executive management team, is it lower level management, and so on. So all these types of information is available. We are putting that to market in collaboration with 2IQ, and obviously it's a very interesting data set. What's quite interesting as well, actually, is also the interaction between what you will see from the filing and what you will see from news. Because in the insider transactions data set, we do have metrics that also talk about the materiality of these insider transactions. And it's quite interesting to see that things that normally would be considered immaterial, so that is, it's not by, let's say it's for taxation reasons or not an outright purchase. If it's actually covered in the news, it will be treated as if it's material. So the interaction between the different ways of looking at insider transactions from filings versus news actually also provides very interesting insights. We can probably cover one or two more questions before we have to wrap up. There was a question around our performance metric, whether we only look at it from a cumulative return perspective, or whether we also consider other ways of measuring it. Anmar, I don't know if you want to take that one.
Yeah, sure. This is a good point. I think that when you evaluate the predictive power of a signal, you have to take into account the risk-adjusted performance, but not only. You have also to take into account the portfolio turnover, because when you are dealing with news and short-lived information content, you have to take into account how you rotate your portfolio. So basically, we usually map the risk-adjusted performance, the information ratio, roughly speaking, to the portfolio turnover, and also to the effective number of bets. This is the effective number of components of your portfolio to evaluate the conviction that you put in your portfolio based on your signal. So basically, I would say you have on one side information ratios, and on the other side portfolio turnover plus the effective number of bets.
Thanks, Anmar. And here I'll take one last question here, and then we probably have to wrap up. There's a question here on if we are generally trying to predict the price of the following day, even though certain events should in theory have a more long-term effect, or do you allow certain sentiment scores to carry over to following days? I think that sort of goes into the core of signal construction. We generally look at doing sentiment signal in the aggregate. Of course, you can go thematic, and that's the way that you might be able to treat different types of events differently, and then combine either, for instance, at signal level or at strategy level, having slower or faster moving strategies or signals. But generally, we try in our research to keep it relatively simple, because it's mostly meant for inspiration, how our clients can work with the granular sort of real-time data that we provide. We try to do it for inspiration, and we try to keep things relatively simple. So if we do, let's say, an average sentiment score for the day or for a week or something like that, we would treat all news, let's say, symmetrically, unless we go thematic, right? And so it means that you could potentially create something even stronger or something that would decay slower if you were to treat different kinds of news, different kinds of events asymmetrically in a different way, right? So it all comes down to the complexity of the signal that you wish to construct. So with that said, I think that was all that we were able to cover in today's webinar. If we weren't able to get to your question, we'll try and reach out separately via email. And again, thank you for tuning in, and thank you to Anmar and Paolo for their presentations and willingness to answer all of my questions. Should you be interested in reading more of our research or trialing our data, please go visit ravenpack.com. And with that said, have a great day.